Hello, hello. Welcome to my next series in the Building Foundations for Financial Wealth series. Tonight, we're going to talk about traditional investments. So a lot of people don't have clarity sometimes with what traditional investments mean. So that's what I'm going to talk to you here about tonight. So welcome to everyone. I appreciate you being on the call, and hopefully I'll teach you something new today. So again, traditional investments, I've had previous webinars where I talk about non-traditional investments and investments in general. So tonight will be on the traditional investments that many of you I know are familiar with, but I'm going to do a deep dive in what that means. So many of you I know about that are on the call know about my radio show. Of course, some of you don't. KNX 1070 on AM. That's one of the oldest stations in the country, which is always fun to be on. So by all means, listen to my radio show. And if you can't listen on Saturdays and Sundays where we play it at 7 to 8 a.m. on Saturdays and 6 to 7 a.m. on Sundays, you can always go to my you can go to my website, californiawealthadvisors.com, and click on the radio tab, and it will show all of my previous radio shows, 2.5 years of radio shows on there. So listen to those too. Great way to get to know me and to just learn about different aspects of investing that I talk about on the radio show. Also, many of you know I have written a book, The Great Retirement Mystery, How to Avoid the 6 Biggest Blunders. This is available on Amazon and on my website as well, californiawealthadvisors.com. It says retirement in the title, and I do specialize in retirement planning, but this book is appropriate for anyone, even if you're 20 all the way up to 80, because I do have in there how to avoid the 6 biggest blunders. And those big blunders is really imperative for everyone to be aware of. So let's make sure that you're not doing any of those blunders in your particular portfolio. And one or two of them is, who are you listening to? Are you listening to somebody that's actually a professional wealth advisor? Or are you listening to your sister's best friend? And trying to time the market, that's another big blunder I see a lot of people try and make as well. So just a couple of those, but great book to have. It's not real big, so it's easy to read, and comments I've had lately are that it's an easy read and very informative, so I appreciate that. So by all means, get my book if you're interested in learning about retirement planning, or you're learning about how to avoid the big blunders I see out there. Okay, so what are the key components to investing? And basically, there's 2, and I talk about these constantly on my radio show or constantly to my clients when they come in and see me. So number 1, have a plan. You've got to have a plan to your investments. I see so many people come in with large accounts, large 401ks, $2-3 million in their 401ks, $1 million sitting in cash in the bank, and they have no plan for it. It's just sitting there. It's not particularly doing what they want it to do. There's no plan for it. It's just an investment account. There's really no plan. So I want to have a plan that's designed for you, that's specific to you, based on your time frame, your goals, your risk tolerance, and this is different for everyone. So we need to have a plan that's specific to you. And again, that's what I specialize in doing, is creating plans specific to you, based on your needs. The second thing that's really important for a component to investing is to have diversification. You've got to have diversification. Don't have all your money in the market if that's not your risk tolerance, because of course the market goes up and down. So if you're at retirement, you're getting closer to retirement, or you have funds that you really don't want to take a lot of risk with, and that's where you're at, well, that's probably not a great strategy for you. So having diversification in your portfolio, absolutely key. I talk about my mass proprietary process. M is the market, A is alternatives, and S is safe money. And I'll go over that more in a minute. But to have diversification amongst different asset classes is very important. It's really vital to you for your overall investment strategy. And I want you to think about where you're at right now. Where are you? Do you have all your money in the stock market? Is your 401k all in stocks, bonds, or mutual funds? If it is, you're more closer to that red section, if you will. I have that red for a reason. There's volatility with the market. Markets go up and down. So stocks, mutual funds, even bonds can go up and down. And again, I'll go in a deep dive with those in a minute. But you need to have your investments maybe not so much 100% in the market if you're getting closer to retirement, particularly if you're getting closer to retirement, particularly if you need the assets for something else. Maybe you're going to buy more real estate or something. You really don't want to take that much risk. Well, we need to move you over more towards maybe the annuity side or the CD side or the cash side if you need investments or you want investments more liquid. So again, where are you in the spectrum? And most of the time, that when people come to me, they're really more in that red side. They're in the stocks and the mutual fund side, especially in their investment accounts, especially in their 401k accounts. So that's why people come to me, because they don't want to be 100% in the stock market. They really do want to have more diversification. And again, this seminar tonight is on traditional investments, more about the stocks, bonds, and mutual funds section. I'm gonna take a deep dive into annuities as well. But if you're interested in non-traditional investments, investments away from the stock market, away from stocks, bonds, and mutual funds, that's what my non-traditional seminar is on. Or I have a lot of live events as well. I'll get to those a little bit later to educate you on different investments that might be available to you that might be appropriate to you. So just know that I have an ongoing series, Building Foundations for Financial Wealth, as well as outside seminars, product-specific seminars in addition to that. And really just go to my website, and I have a lot of seminars on there constantly. Okay, so let me go back to this other slide. Sorry about that. Okay. My thoughts on traditional investments. Again, where are you in the realm of investments? So this is my master proprietary process. Everything on the planet is here somewhere. Stocks, bonds, and mutual funds is the red part. That's what I'm going to talk about tonight. I also am going to talk a little bit about annuities, the dark blue part. And then I mentioned earlier, alternative investments or non-traditional types of investments. Many of those are real estate, oil and gas, private placements, things that don't go up and down with the market. So again, where are you in this spectrum? And I think it's really important to have funds in each one of these sections for most investors, because I want you to be diversified. I want you to have different asset classes in your portfolio to really help you manage through whatever markets we come in. Up markets, down markets, flat markets. What are you doing to combat that? And I found in my years of working with folks in their portfolios that having that diversification, not having all your eggs in one basket, is very key for you. Okay, traditional investments. What are your goals? What resources do you have? What is your risk tolerance, your time frame that you have for your different investments? Some questions I want you to start asking yourself is which investments meet the objectives that you have, and that is actually something I will answer for you, but depending on what investments you have and where you're trying to go. I want you to think about risk. How are we going to mitigate risk in your portfolio? I'm going to talk tonight about what's the difference between a stock and a bond. A lot of people are not familiar with that. And also a deep dive into bonds, and can you lose money in bonds? And yes, you can. I'm also going to talk about here what is a diversified investment program, what that means for you. And then again, I am going to go a deep dive tonight into annuities and what the difference is between a fixed index, and a variable annuity, because a lot of times people don't know those differences. And I will say most advisors don't know how to explain them too. Some suitability concerns that we see, we want to address the risks in your portfolio. What kind of portfolio do you have? And what kind of risk do you have? And I want you to manage the volatility in your portfolio, especially if it's in a retirement account, or it's an account you are leaving towards your children, a legacy passing perhaps. I'm going to talk tonight about investment basics, certainly, and having those diversified programs too. I am going to talk about third-party money managers as well. So those are managers that manage your money for you that I choose, of course, and then find the best ones. And then again, I'm going to talk about annuities and savings accounts as well. Okay, some suitability concerns we have. What is your time horizon? What is your risk tolerance? These are way important, way too important to ignore here. And this is different for everyone. It really is. So we've got to know this for you. And that's why when I sit down with you, I'm going to ask you a lot of questions. And let me add here, if you have questions, you can type them in. If I don't get to them, it's likely because I feel like I'm going to answer them during the seminar, or I need to take it offline to answer those there. Okay, just so you know if you have questions. Okay, we are going to address portfolio risks for your portfolio, certainly. We want to make sure that the risk that you have in your portfolio is appropriate for you. And what are those different kinds of risks that are out there? Well, there's systemic risk, overall market risk. What is the market in general doing? Then managerial risk. Well, who's managing your stocks, bonds, and mutual funds for you? Is it someone like me, a professional wealth management that does this all day? Is it your brother's best friend? Really, who is managing these for you? That's the managerial risk I have. We can look at it as, is it Warren Buffett that's managing your assets for you? Or is it John Smith that knows nothing about investments? So really, there's a big difference there, and it's important to have a professional on your side. That's exactly what we do at California Wealth Advisors. We are a professional. We are on your side. The other thing I want you to think about is systemic risk. So that's inflation, interest rates, certainly disasters. Inflation and interest rates is hitting all of us in the pocketbook these days. So what are you doing to combat that? And if you're not doing anything, or you haven't thought about that in your portfolio, we need to sit down and have a conversation. Inflation will affect your portfolio. I just did this on the radio show recently, $50,000 today, you'd need $162,000 30 years from now at a 4% inflation rate to equal that. That's a big number. That's a big difference. So what are you doing to combat that? And generally what I do when I set up portfolios for folks is I have inflation hedges built in portfolios already. I already have that in the portfolio that we're looking at. Interest rates, of course, have risen. That makes it good for some of the money market accounts that we have. Those are paying higher yields, over 5% these days, which is nice. A year ago, 2 years ago, money market accounts were less than 1% probably. So we do have money market accounts that are paying a little bit higher than that. But that's something to consider as well for your portfolio. And then, of course, event risk, defaults, bankruptcies, earthquakes that happen, hurricanes, different things like that can affect portfolios too. And again, I ask you, what are you doing to combat any of these types of risks? And if you haven't done anything, you need to call us and get yourself on our calendar to make sure we've addressed this for you. Okay, how do we mitigate risk? Well, we do that through the diversification process, because again, when we don't have all assets in one thing, for instance, the stock market, and let's say the stock market goes down, well, your portfolio is going to go down. But if we have diversification, and we have some stocks because we like the liquidity of it, maybe we have some investments in the alternative space, the real estate perhaps, to mitigate some of that diversification from the stock market. So your portfolio is not going up and down every day like the stock market. And maybe we do some investments in the safe section. That's the insured types of products. So having diversification is absolutely key. Some government-backed programs, I'm going to talk about U.S. Treasuries in a minute. And then, of course, insured programs, which is either life insurance or long-term care, or the annuity types of products I'm going to talk about in a little bit. Again, where are you in the master proprietary process? Where are your assets now? And are they professionally managed for you? Do you have money in a 401k and it's just sitting there and you really don't even know what's in there? You probably don't have personal management on those funds. That's why people bring me those 401k accounts. When you have money in the safe section down here and the light blue section, not just the red section, it tends to bring people more peace of mind because they're not all tied to the stock market. So I want you to think about where you are in this total scheme of investments. Okay, again, let's move on to volatility and what we can do about that. How do we manage through volatility? Well, again, diversification, and I can't even say this enough, diversification is key. Don't have all your assets in one thing. One stock. I have a client that just met with me today. He's got $750,000 in one stock. That's probably not wise. I have clients call me from the radio show and they've worked for a company for a long, long time, 40 years or so, and they have $2 million in that one company stock. That's not diversification. Correlation. Okay, what are you doing for managing through volatility with correlation? Again, are you all tied to the stock market? If you are, you're totally tied there. We need to uncorrelate you, if you will. We need to make sure you're diversified. Okay, let's go through some investment basics here. Okay, so here's a deep dive into bonds. Again, I'm going to talk about stocks, bonds, and mutual funds in depth here. So bonds, and a lot of people don't know about bonds. They hear about them, but they're not really sure. So let's do a deep dive here. So bonds, primary market, secondary market, and the different types of bonds. So primary market is when you buy them from, I'll go over this in a minute, but when you buy them directly from the issuing agent. And the secondary market is anything that's traded on the exchanges. The different types of bonds, government bonds, I'll go over those in a minute, municipal bonds and corporate bonds. I'll go in a deep dive to those in a minute. Again, those are the different kinds of bonds. I started my career in doing municipal bonds, and many moon ago. And so I know a lot about bonds, but they're not bad, but there's reasons why I don't put people into bonds. I'll cover that shortly. Okay, let's talk about U.S. Treasuries. So U.S. Treasuries are backed by the full faith and credit of the U.S. government. They're considered some of the safest places to invest your funds. Generally, no one thinks, I don't think, that the U.S. economy is going to go bankrupt, because we have taxes coming in that you and I pay, businesses pay taxes, so that's constantly money coming in. Now, I won't get into politics and where people spend the money that are there, but U.S. Treasuries are considered some of the safest investments around. So Treasury bills, Treasury notes, and Treasury bonds are the three types available in this area. So Treasury bills are sold in denominations of $1,000, so are Treasury notes and Treasury bonds for that matter. But Treasury bills really range from a year or less. So a lot of times we do money market accounts that are buying U.S. Treasury bills short term. So 6 months, 9 months in maturity is usually what I see there. Treasury notes, on the other hand, are mature anywhere from 1 to 10 years. And then Treasury bonds are 10 to 30 years. And a lot of times you hear economists talk about the 10-year U.S. Treasury bond. That's what they're referring to there. All of these are subject to federal taxes only. You might be able to have state taxes tax-free to you, which is nice. And there's very low risk involved, again, in these types of bonds. The Treasury bills have no coupon payment. So if you put in $1,000, it matures in 6 months. That's when you're going to get your principal back and your interest. Whereas Treasury notes have semi-annual coupon payments, as do Treasury bonds. Municipal bonds, again, I started my career many, many years ago with municipal bonds, and I love municipal bonds. In the day, I had 20-year, 9% state and federal tax-free bonds that I put clients into. It was great. They loved it. But in the last 30 years, we really haven't had those kinds of returns for those types of bonds. So municipal bonds are issued by state and local governments, and they're used to raise revenue for that area. General obligation bonds are really backed by the credit and taxing power of the issuer. So a city type of thing, debt service of that area. They're considered less risk because it's based on the revenue generated from that taxing power. Whereas revenue bonds are backed by the revenues or earnings from that particular project. And that would be airports, toll roads, things like that. It's considered a little bit more risky, I guess you could say, than the general obligation bonds, because that project may not be successful. But again, municipal bonds are backed by municipalities, which is a government agency. So I don't think there's a whole lot of risk there generally, but again, it depends on the rating of that particular bond. Corporate bonds, okay, I won't go into too deep a dive here, but corporate bonds, really, there's many different kinds of them available, and there's many different rates and timeframes you can get for corporate bonds. Again, these are bonds issued by corporations themselves. So lots of different ways to take advantage of that. Let's talk about pricing of bonds, and this is true for municipal bonds, corporate bonds, even U.S. Treasuries too. So let's talk about this. So you have $1,000, let's say today, and it's a 6% interest rate. Okay, let's say interest rates go up from here. Well, your bond, if interest rates now turn into 7.5%, your 6% bond is not going to be worth $1,000 anymore. If you sold it that day, it's going to be worth more like $800 because as interest rates rise, bond values go down. So there's a discount to your bond versus new bonds that are coming out there. Let's take the other side of this, and let's say interest rates go down. So interest rates go down, you now have 6%, everybody else is only getting 5%. Well, your $1,000 bond is now worth $1,200, so it's worth more. Now remember, prior to last year, 30 years prior to that, we had a bull market in bonds. So interest rates were coming down, so bond values were going up, which was great. But what's happening now is as interest rates rise, bond values go down. So I would suggest that if you have a large bond portfolio, you may want to really rethink that and take the profits you have off the table there for any bonds that you might have that are paying that higher interest rates. Maybe you bought them 20 years ago and there's value there. Well, I would solidify that gain because I think as interest rates go up, those bond values are going to go down. So let's make sure we're doing the right thing for you and we have the right strategy going for you. Okay, there's different kinds of risks in the ratings of these bonds too. So the AAA rated bonds, they're considered the more secure end of the spectrum there, if you will. So their interest rate is going to be lower. If you go up to a AA rated bond, your interest rates might be a little bit higher. And then B rated and C rated, those are lower rated bonds. So your interest rate is going to be much higher for those. And there are different kinds of credit ratings outfits out there, Moody's being one of them, Standard & Poor's, Fitch. So the strongest rating is the AAA. The weakest is C or D rated bonds. Now, what's the difference? Well, you get a higher yield from the weaker rated bonds because you're taking more risk, right? So again, make sure that the bonds you have are where you want them to be. Okay, let's talk about stocks, equities, we also call them. Another way for corporations to raise money is by selling stocks in the ownership of the company. And you can figure out how much you own of a company by figuring out the number of shares and the shares outstanding and what you own there. So company size. There's small cap, mid cap, and large cap types of companies. So the small cap, I would say, are 300 million to 2 billion in size. These are often considered growth oriented and probably more volatile as well. The mid cap stocks, I would say 2 billion to 10 billion. They're called mid cap corporations because there's a little bit more opportunity for growth. Maybe less volatile than the small cap companies, but maybe not as solid as the large cap ones. So large cap ones, of course, are 10 billion or more in size, very large companies, IBM, AT&T, Apple, those kinds of companies. We're not looking at these necessarily for growth. We're looking at them as more as a stable asset class and a more stable price, if you will. Now, can they go up and down? Absolutely, because they're stocks. But that's what we're looking at there in the delineation of all of those. Okay, the growth stock ones are typically smaller companies. As I mentioned, they forego paying dividends most of the time because they're looking for just the stock price to go up over time. The income stocks, again, more stable stocks, more of those blue chip types of companies that pay a nice dividend. We like those in a lot of portfolios, especially when folks retire, to create that income that will last for a while. Now, can income go up and down in those solid kinds of stocks? Certainly. But again, we're careful with when we look at there. Different kind of class stocks. There's common stocks, there's preferred stocks. Common stocks, of course, you do have voting rights. And I know some people get things in the mail all the time about voting, but that is your right. You are owner of the company. Preferred stocks, you have no voting rights, but you are higher in the capital stack if anything should happen with the company, whereas the common stock are lower in the capital stack as far as anything happening to the company. Preferred stocks, generally dividends are fixed, they're more stable. So having part of that in your portfolio is a lot of times a good idea too. Okay, the primary market. All right, let's talk about that for a second. So initial public offerings, those are when the company's issuing new stock or a new company's coming to the market. You hear that on the news sometimes, initial public offering types of stocks. And then, of course, the secondary market, that's where most all of us buy and sell our stocks on the secondary market. And you know, both are great. It's kind of hard sometimes to get into the primary market because it's not publicly traded yet and there's a limited shares. All right, the secondary market, where again, most of us buy and sell our stocks, is the New York Stock Exchange, the NASDAQ, the NYSE American Equities or American Stock Exchange, you could call it, are places where the exchanges happen. So how to measure performance? Okay, so a lot of times reference the S&P 500, which is the top 500 firms market weighted in the S&P. The Dow Jones Industrial Average, of course, is 30 corporations. They're usually very large companies, but there's only 30 of them in the Dow Jones Industrial Average. So when you talk about the Dow going up or down, that's really based on only those 30 stocks. So if you're looking for a wider range of what's the market doing, well, look at the Standard & Poor's 500, look at the Wilshire 500, look at the NASDAQ Composite, or even the Russell 2000. Different indexes will yield different things and tell you different things about markets. Okay, diversified investment programs. Again, mutual funds, exchange traded funds, unit investment trusts, all kind of, I'm putting them together in the mutual funds section, if you will, because none of these buy individual stocks for you. Mutual funds, of course, buy 100, 200, 500 different stocks in a portfolio. Very diversified. I use them for that diversification purposes. I'll talk more about the managed accounts that I do that buy individual stocks in a minute, but mutual funds can be great. They are traded in and out every day, so you can go in and out of them as you need to. Exchange traded funds are based on an exchange, how an exchange is performing. Maybe it's the S&P 500, for instance. How is that trading? And an exchange traded fund will be based on that exchange. Unit investment trusts, for those of you that don't know, are a set group of securities. They buy a set group, and usually they're 2 years in length, the ones that I'm familiar with. And then they sell them all in 2 years, and then you get your money back higher or lower than whatever you started with. But it's a set group. They don't change it like mutual funds will be buying and selling stocks all the time. So will exchange traded funds. But unit investment trusts will hold on to those same securities for the duration. Okay, let's talk about third-party money managers. I love the third-party money managers because it gives you access to institutional money managers. And what do I mean by that? Well, these are institutional money managers that usually you have to have 10 million, 50 million to invest with these institutional money managers. Most of us don't have that. We might have something less than that, but it gives us access to those money managers that actually manage those large portfolios like that. What I love about the third-party money manager too is, again, they buy individual stocks for you and they personalize a portfolio for you. Many of the ones I deal with buy 40 different stocks per portfolio, again, depending on what your goal is. If you want small to mid cap stocks, or maybe you want US dividend paying stocks, but they're going to personalize that portfolio for you specifically. And what I kind of like about them too is you can really personalize it for you. If you say, hey, I don't like tobacco stocks, okay, they won't put any in there for you. Say, I don't want any oil and gas stocks. Well, they could leave those out for you. So I love that personalization we can get with those institutional money managers. And again, it gives you access to very large money managers that this is what the Harvard Endowment Fund, CalSTRS, for instance, these are the money managers they work with a lot of times. So the advantages here are that the capital gains that you get, unlike mutual funds, are specific to your portfolio. Much better for you, because in a mutual fund, you can have a gain and maybe you've only owned that mutual fund for 6 months and it's actually gone down in value from where you bought it. But the 6 months prior to that, it went up in value and they solidified those gains. Well, guess what? You have to pay those taxes on a mutual fund. Not the case here with the third-party money managers. Those embedded capital gains are indicative to your particular portfolio. And again, the pricing, you can get a better pricing with these institutional money managers. And of course, bundling is better as well. Some of the disadvantages of some of these third-party money managers is that they do have high minimums, 100,000, 300,000, 500,000, a lot of times minimums for those. Less diversification because they're not buying 100, 500 stocks for you. I actually like that better. because they're going to buy 40 different stocks for you. And of course, you can have complex strategies in those as well. All right, let's talk about annuities. Let's do a deep dive into annuities. Okay, there's 3 different kinds of annuities, and this is what most advisors are never going to explain to you. I don't know if they don't understand it or they don't know how to explain it, but I'm going to make this hopefully very clear to you here. So there's a fixed annuity, there's fixed index annuities, and there's variable annuities. So what do I mean by that? Well, this chart shows over a 30-year period of time how they can work. So a variable annuity is really the red line. Variable means they're buying you mutual funds. It's going to go up and down in value. Now, over long periods of time, it can do very well. But what I see with variable annuities most of the time when people bring them to me to look at and evaluate for them is, yes, they go up and down, and they have very high fees. And the advisors that sell these to you are very happy because they're making large fees every year, but it's really not to your benefit. I had a client come to me recently and she said, oh, this annuity, this variable annuity I have that I've owned for 10 years hasn't really performed great, even though the stock market has done well. And she said, my advisor told me it was a guaranteed 5% rate of return. Well, she had averaged about 2 to 3% as I looked at the statements. And I said, wow, there's something wrong here. So I looked at the fees that he charged her, whereas she might have been guaranteed 5%, but she was really paying about 3 to 4, 5% in fees every year. So her return wasn't that good because it was eaten up by most of these fees. So when I do variable annuities, I do very low cost ones for folks. But if you have an older annuity that hasn't performed great, even though it has some kind of guarantee to it, it might not be performing because of the fees that are involved there. So again, I will look at that and evaluate that for you if that's something you have. Again, variable annuities can be great for long periods of time. Markets in general, no guarantees here, but in general will go up over long periods of time. So that's the red line, going up and down with the variable annuities. A fixed annuity is more like the light blue line. You're going to have a fixed interest rate. Maybe it's 3, 4, 5% over, let's say, a 10-year period of time. It's going to mature in 10 years. You get your money back. Nothing's gone up and down. You've got a fixed rate of return. That's more like a CD, I would say. So that's a fixed. A fixed index is really between the blue line and the green line, because the blue line is your guarantee. You're never going to go down in value. Again, these are backed by insurance companies. So that's the insurance you get. So the blue line with a fixed index annuity is your guarantee, and the green line is what you could potentially get. But you will never be negative. You'll never go in that red section, that down section of the red, because you're guaranteed by the insurance company to not take out less than you invest. So the potential upside of the market with the fixed index annuity, with the guaranteed by the insurance company, downside with the fixed. So it takes the best really of both of those worlds in my view. Some years you're going to have a 0% rate of return because if the market's going down, you're not participating in that. You put in 100,000, it's going to stay at 100,000. Some years are going to be 9%, 12%, whatever the market goes up, you're going to participate in that. And then you can also turn on income streams from these that will be guaranteed for your life. The only product I have really that will do that, again, backed by insurance companies. And we can do inflation hedges in here. Remember, I started talking about inflation hedges in your portfolio. We can have inflation hedges built into these for you automatically, whereas your interest, your income rate would go up each year over time. And I can do illustrations and show you that. So the annuities, I think, are wonderful as part of a portfolio. I just had a client come in today, actually, and he said, I want maximum growth for this 200,000. It's for my kids. I don't want income. I don't need income for life, but I want to have maximum growth. So I shopped it around, because that's what you get when you come with me as an independent financial firm. I'm not going to just be tied to one insurance company. I shop it around to 20, 30 different insurance companies to find the best annuity for you. So in his case, I found the best annuity that really has great participation rates, which means his value can go up quite quickly over time. And maximum growth for him, which was great, which is what he was looking for. So again, if you're looking for income streams guaranteed for your life, your spouse's life, that's where we go. We go to these annuities for that. benefit, if you will. Life insurance, I'm not going to get into too much here. If you have an old life insurance policy and it really hasn't performed very well for you, then call us, because a lot of times we can increase the death benefit. We can perhaps lower the premium. We can set long-term care as part of the portfolio, and you actually can turn on income from these policies as well. So again, life insurance, if that's something of interest to you, I would call us. If you have a cash value life insurance policy that really hasn't done well for you and you want to see if you can improve it, or you want to see if you can add long-term care, a lot of times we can do that for you. Okay, the benefits of fixed indexed annuities. Well, we can take savings that you have in the bank that you're not doing anything with and create a downside protected by the insurance company upside potential for you from those funds. Again, the growth potential is there for you. Protection of principal, again, it's guaranteed by those insurance companies. And by the way, the majority of the insurance companies I deal with are not new. They've been around 50 years, 100 years. They've been around a very long time. You can also get, of course, the income that's guaranteed for your life, which is great. Now, if you don't need anything out of this annuity, it can be tax-deferred growth, tax-deferred income within the account for you as well. So they're kind of like bond replacements, if you will. Where do we go for income? Where do we go for growth that's tax advantaged? Well, we can get that from the annuities as well. Lots more options there. And what I will add here is predictable income that will be guaranteed for your life really does help make retirees happier because they know what income they're going to get. So that's a nice plus to those as well. All right, let's talk about savings accounts. Well, passbook savings accounts, those are yielding what we call 0 point nothing at the bank. So savings accounts at the bank, what I've seen generally don't pay a whole lot. Money market deposit accounts, well, we actually have some now that are paying very well, over 5% in many cases. So if you have money in the bank that's just not earning much, a lot of times people bring me those funds. Again, it's liquid. We can go in and out whenever we like, but it is a nice paying dividend yield right now. And then certificates of deposits, I don't do a lot of those because if you get a 6-month CD and it's paying 5%, but I can get you 5.3% in a money market account, why would I tie up your money for 6 months? So again, different ways of savings, which is good. Now, I want to say I am a fiduciary. I would never know how to be anything else. I always put your need before anyone else's, absolutely. I've had several people actually come to me lately and they say, oh, I talked to my advisor and I asked him if he was a fiduciary and he said no. And I said, oh my gosh, wow, I don't think that's good. You need to be a fiduciary. I would always put your needs above anyone else's. We are A+ rated on the Better Business Bureau, which is very nice. And then the complimentary services that we do, of course, we do the portfolio reviews. I don't charge for that. That's part of our overall service. That's keeping in touch with you. That's letting you know how your portfolio is doing, going over in detail your portfolio to let you know what's happening with it. We do look at Roth conversions for a lot of folks too. Debt management, I want you to get out of debt as much as you can before you retire, so I'll help you with that. Cash flow projections, we do this all the time to show people once they do retire based on their assets, what kind of income can they get? And then this is, of course, based on your assets and then what your budget is. And I have that on my website, your budget sheet. If you've never done that, please do that. Please print it out, CaliforniaWealthAdvisors.com. And know what your budget is, know what you're spending every month. Do one for now, do one for when you're going to retire to figure out how much money you will need in retirement to make yourself happy. I also have the bucket list on my website too to think about what you want to do when you retire. And maybe that's going to cost something and maybe it's not, but let's know that ahead of time. Let's have some emergency funds. I usually tell people have 6 months of your budget in the bank because you might need it for emergency purposes. So that's why I tell you, you need to know what your budget is to have 6 months of that in the bank. Retirement planning, of course, that's what we specialize in doing. We also help people, of course, outside of retirement accounts as well. But a lot of our clients need help in that retirement planning stage. They need to know what kind of income they can create. They need to know how much or what they can do for legacy passing to their heirs as well to protect that. Of course, we're going to provide you with 1099s and any tax documents from your accounts as well. Required minimum distributions are very important with any kind of retirement account once you turn age 73, which is going up to 75 for the next few years as well. Budget planning, we definitely help people with budgeting. And then of course we have these seminars and client events constantly to educate you, to let you know what's going on in the market. We have product specific ones and general ones like tonight, where we talk about investments in general. The people that we work with, a lot of 401ks, many in-service transfers, which means you're still working for the company, but you can roll those funds out into an IRA. Again, no taxes to do that. But now you can have those funds professionally managed, whereas a lot of times you can't do that when you have a 401k, when you leave it at the account. Now, we can sometimes open brokerage windows within those 401ks. We just need to ask. Trust accounts, of course, I work with a lot of trust accounts, and I just had an attorney in the office recently that went over trusts and why you need one. So if you don't have a trust or you haven't updated your trust in the last few years, you need to do that for sure. 1031 exchanges, opportunity zones. We work with people a lot of times to save on taxes as well. So the 1031 exchanges is when you have real estate that you're selling, but you don't want to pay the taxes. Well, we can do 1031 exchanges for you as well for those accounts. And opportunity zones is when you have any highly appreciated asset that you want to sell, that you'd have a lot of taxes on. Again, I had some clients recently come to me. They work for a publicly traded company for the last 30, 40 years. They have a lot of company stock. They want to sell it because their cost basis is very low, but that's where a lot of their assets are. And having all of your assets, a lot of your assets in one security is not wise. So selling some of those shares and doing an opportunity zone, because you can't do a 1031 exchange for those, is very smart as well. It mitigates taxes, delays taxes, actually gives you tax-free returns eventually as well. So and people that have businesses, I have a number of people recently that have had businesses that they sold this year and they were going to have huge taxes. Well, we're looking at opportunity zones for them. So any highly appreciated asset that you want to sell, but you want to avoid and delay taxes, the opportunity zones are great, or the 1031 exchanges if you have real estate. Annuities I went over, again, if you have an old annuity that hasn't performed very well, it might have a cap on it, which means it can only make 3% a year, for instance. And let's say the market goes up 10%. Well, I want my clients to participate in that 10%. But if you have a cap, that means you're only going to make 3% no matter what the market does. So if your annuity hasn't performed very well, either it's a variable or it's a fixed, or even it's a fixed index, you might have a cap on it. And so I always do annuities with no caps to make sure that you're getting the best return you can. And those are 1035 exchanges. Again, taking it from an old annuity into a new annuity that actually has the potential to perform much better for you. Same thing with those old life insurance policies. Again, if you have one that does not have long-term care or hasn't performed very well, or perhaps you want to improve the death benefit, bring those to me and let's see what we can do. And then of course, Social Security, when is the right time for you? I get that question quite a lot, so I can help you with that as well. So our process here, if you're new to me, is the first meeting is to establish and define the relationship, make sure we're a good fit, we can work together. I like that first meeting to be in person because I want to get to know you. I want you to get to know me as well. I'm going to be gathering information, asking you a lot of questions at first meeting. I'm going to take it back to my office. I'm going to evaluate it. I'm going to analyze it based on what you told me. I'm going to develop some recommendations for you. And then the next meeting, I'll present those to you. And then if we decide to work together, of course, we'll implement the plan, get it going for you. And I would say one of the most important steps here is to monitor regularly, doing those portfolio reviews for you. I'm very well known for keeping in touch with my clients. I have staff that their job is to make sure I have my clients on my calendar. I'm doing a periodic portfolio reviews for you and monitoring their accounts to let them know what's going on, which is why I say I can't work with everyone. I've got to make sure we're a good fit to make sure I can do those portfolio reviews for you. And that, of course, we're on the same page. Pay attention to my upcoming events. I have quite a few coming up here. Here's some example, but the events page on my website, California Wealth Advisors, will list all my upcoming events. And if you want to sign up for any of those, by all means, sometimes you have to qualify for some of these. You have to be an accredited investor or a client to qualify for these. But I have oil and gas ones, I have income-oriented ones, I have real estate ones. And of course, I have different parties throughout the year that I invite my clients to. Here's some of the previous invitations, just so you can see those. So again, if you're interested in meeting with us, if you haven't yet, that first meeting I do like to have in person to make sure we're a good fit. I can do Zoom meetings and phone calls. Certainly, I do those a lot with my current clients as well. But give us a call, and thank you for joining us. The questions I see coming in here, let's answer those offline. But pay attention to my upcoming seminars, my webinars. You can Zoom these or you can come in person. I have a conference room here in Santa Barbara where I invite about 20 people is the maximum we can have in the room, but the rest of people we can Zoom as well. So love that you paid attention here tonight. I hope I taught you something new. Thank you so much for participating. Again, if you have any other questions, you let us know and we'll get back to you with those. Thanks so much.